Right now, there is a number on US dollar to Japanese yen that almost everyone is misreading, and it's not the intervention. Price sits at 159.27. Japan just confirmed a historic $75 billion yen buying intervention, the largest quarterly defense since 2004, and yet the dollar barely flinched. That, right there, is the trap. The market smells a rescue, but the chart is whispering something far more dangerous. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow. Write this down. The single invalidation level that flips everything is 160.13. If US dollar to Japanese yen prints a daily close above 160.13, the intervention ghost is dead, the structure resets into a melt-up, and we are targeting 162.00 at speed. If instead we lose 158.80 on a 4-hour closing basis, the floor drops out and a liquidation freefall toward 155.00 becomes live. My session bias is fading the intraday grind while respecting the dominant monthly and weekly trend, and those trends are screaming strong buy. Monthly strong buy. Weekly strong buy. Daily strong buy. But here's the fracture. 4-hour and 1-hour trends are both neutral. That disconnect is exactly where institutions build positions while retail gets chopped. The herd is long, still chasing the uptrend, but they are sitting on top of a powder keg. $75 billion of intervention didn't even push us below 158.00. That tells you the underlying dollar demand, driven by the yield gap, is immense. If the Ministry of Finance couldn't hold it down, what do you think happens when the next US data print prints hot? You get a vertical move. Now let's walk the chart from the top down because this is how you read the pressure points. On the weekly, the 200-week moving average is climbing around 148.00. It hasn't been tested in months. The entire moving average ribbon is fanned out bullishly. On the daily, the numbers are crisp. The 5-day moving average is at 159.25, the 10-day at 159.14, and price is oscillating right around them, digesting. The 20-day is at 158.39, the 50-day at 158.82, the 100-day at 157.69, and the 200-day way down at 155.21. That is a textbook bullish ladder. As long as we hold above the 158.39 20-day, the path of least resistance is higher. But the 4-hour chart is where the poison hides. Look at the MACD. It's still positive at 0.140, but the histogram has been shrinking for 6 consecutive bars while price makes equal highs. That is hidden negative divergence. Buyers are exhausted. RSI on the 4-hour is 55.9, dead in the middle, no momentum confirmation. On the 60-minute chart, we are range-bound between the 38.2 and 50.0 Fibonacci retracements of the last swing leg. Support is laid precisely at 159.03, then 158.80, which is the prior structure low and a volume-weighted average price magnet. Resistance sits at 159.90, then 160.13, which is the intervention spike. High and a long liquidity pull. Here's what most traders miss. Intervention doesn't just disappear. It leaves a liquidity shadow. $75 billion of yen buying means those yen short positions were absorbed, but the dollars sold by the MOF are now sitting in reserve. The moment the market senses the BOJ is done, that dry powder turns into fuel for the next long squeeze. And the yield differential story is brutal. The US-Japan 10-year spread is still over 300 basis points. Every day that passes without a Fed cut, the dollar earns carry. This is not a sentiment trade. It's a math trade. Cross-asset linkage is flashing clear signals. US 2-year yields are coiling. If they break above the recent range, US dollar to Japanese yen goes vertical with equities, because the correlation with the S&P 500 is tight right now. Risk on equals yen weakness, and the S&P breadth is improving. Gold is stuck in its own range, not yet signaling fear, which tells me the intervention scare is localized. This is a yen crisis, not a dollar crisis. For the next 1 to 2 weeks, my directional lean is a grind higher, a test and likely breach of 160.13, followed by a stop run toward 161.00. The scenario that kills this lean is a surprise BOJ rate hike or a coordinated verbal escalation with the Federation. But price invalidation is mechanical. A daily close below 158.00 would shift the bias to neutral and open the trapdoor. Do you think the dollar breaks 160 this week? Comment yes or no right now. I am tracking consensus live. Most people skip this section. That's exactly where the money is made. Keep watching because I'm going to lay out 3 exact trade plans with the sniper levels, stops, and targets that you can screenshot right now. Strategy 1, the sniper, conservative. This is for the trader who wants to let the market prove itself before committing. The trigger is a pullback into the 158.80 support zone. I want a 60-minute bullish engulfing candle closing above 158.90 after tapping 158.80, with RSI on the 60-minute turning above 40. Entry on the next candle open with a stop loss at 158.40, which is below the 4-hour demand zone and under the 50% Fibonacci retracement. Take profit 1 is 159.90, just under the intervention resistance, giving you a clean 1.8 to 1 risk reward. Take profit 2 is 160.70, targeting the breakout extension, pushing the trade to a 3.4 to 1 reward. This setup is void if the 4-hour candle closes below 158.50. That would signal the demand zone has failed and the intervention flow is real. Let me put that on screen for you now. Strategy 1, the sniper, conservative, entry, 158.90, 60M bullish engulfing close above after tap of 158.80, stop loss, 158 to 40 take profit 1, 159.90 take profit 2, 160.70 risk, reward, 1:3.4 are invalidation. Void if 4H candle closes below 158.50. Strategy 2, the active trader, standard. This one plays the breakout that the institutional algos are hunting. Entry condition, a 1-hour close above 159.90 with volume. Confirmation, no wick rejection. Stop loss placed at 159.50, just below the breakout point and under the 5-minute order block. Take profit 1 is 160.80, inside the next liquidity pool. Once target 1 is hit, move the stop to break even and let the runner go to take profit 2 at 161.60, which is the 127.2% Fibonacci extension of the last up leg. The trailing stop rule after target 1 is simple. Trail by 25 pips on a 1-hour closing basis. This setup gets voided if we see a false breakout. A 1-hour close back below 159.60 after entry. Type your US dollar to Japanese yen range for tomorrow in the comments now. Let's see who's aligned. I read every single one before the London Open. Strategy 2, the active trader, standard, entry, 159.90, 1H close above, stop loss, 159.50 take profit 1, 160.80 take profit 2, 161.60 trailing stop, 25 pips on 1H close after TP1 hidden validation. Void if 1H closes back below 159.60. Strategy 3, the aggressor, high risk. This is a counter-trend short at the intervention ghost level, only for those who can lose small and manage risk aggressively. Entry on a 60-minute rejection of 159.90, specifically a shooting star or bearish engulfing pattern with RSI above 70 on the 15-minute. Stop loss is brutally tight at 160.20, just above the 160.13 intervention high. Take profit 1 is 159.00, the intraday support. Take profit 2 is 158.80, the structural floor. This is a scalper's dream but a latecomer's nightmare. If you hesitate, you're toast. Warning, going against the monthly trend means you are standing in front of a freight train. Position size must be half your normal risk, and you must exit the moment a 60-minute candle closes above 160.15. No exceptions. Strategy 3, the aggressor, high risk, entry, 159.90, 60M rejection candle, RSI 15M greater than 70, Stop loss. 160.20 take profit 1. 159.00 take profit 2. 158.80 risk, reward. 1:2.2 are invalidation. Void if 1H close above 160.15 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like US ISM or BOJ statements. Stops are non-negotiable. This is how you survive to trade the next big move. Let's close this with surgical clarity. The most critical level for the next session is 160.13. If that breaks, the intervention era for this cycle is over and the melt-up is real. If instead we lose 158.80, the ghost of the BOJ wins and a freefall toward the 200-day moving average at 155.21 comes into play. Tomorrow I'm doing the full breakdown on gold and the real yield collapse. That video is live now. Tap the end screen to watch it directly after this. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one before the move happens.